This is a Crypto Legends podcast.
Crypto adoption is increasing, but the financial world is at its crossroads. We've got the crypto industry facing unprecedented challenges such as regulators scrutinizing the industry, leading to backlash, as is the case in the US with Operation Choke Point 2.0 and famously referred to as such. We've got the ever-present risk of debanking, so banks going into the relationships with crypto and then leaving those relationships in an abrupt manner. We've got we're going to talk a bit about the adversarial history between banks and tier one banks, but also banks as a whole and the crypto platforms or the crypto industry, and what cooperation could look like in the future. So I'm really excited to introduce our amazing guests for today. Daniel Goldman from Orbital is our first guest. Daniel has vast experience in connecting the traditional financial industry with the crypto industry as head of partnerships at Orbital, a regulated blockchain and traditional payments bridge. He will share with us his experience. Orbital chiefly operates under strict financial industry regulations while building relationships with banks, hence Dan's experience is extremely relevant to the conversation today. Dan, welcome back to the show.
Man, it's great to be back. Thank you.
Our second guest, Frank Wong, making a first appearance on our show from BitGo. Frank has a background in banking and investment research and is currently the executive director of platform sales at BitGo. BitGo is a leading infrastructure provider of digital asset solutions offering regulated custody, wallets, staking, and trading. Frank will share with us his experience and knowledge in digital asset security and custody, as well as risk management and compliance in the crypto industry. All very fun topics to discuss. Frank, welcome. It's really great to have you.
Thanks, Adam. Happy to be here.
Awesome. So on the agenda today, as hinted, we've got the current state of regulation and the consequences of the current state of regulation in crypto. We're going to be talking about importance of KYC and AML. Continues to be very important and continues to be, the trigger point for a lot of action or reaction in our industry. We're going to be talking about balancing anonymity with compliance, always a fun subject. And we're going to be talking about the future of banks and crypto. So let's jump right in. Let's start with banks. Tier one banks, we all know, what they stand for: stability and, more importantly, ability to absorb unexpected losses or hits. They face unique challenges when onboarding crypto platforms. I think that much is clear. I want to dive into, discovering what is the case for the challenges that the tier one banks have, and what can be done to facilitate more, cooperation and ultimately leading to adoption of crypto among traditional banks. And how does that sort of intersection between traditional banks and crypto businesses look like today? So crypto platforms are facing a lot of backlash from tier one banks. Why is that the case? Why do we have such severe regulatory scrutiny, especially in the US? Why? Maybe Frank, I'll start with you if you want to tackle this one.
I would say it's not just the tier one banks, it's banks in general in the US, but tier one banks in particular have a more difficult path than banks in general. And that's because these tier one banks are largely publicly traded. They're listed in the US. And as some of our viewers or listeners may know, there exists something called Staff Accounting Bulletin 121 from the SEC, which states that if you're a publicly listed company, such as a publicly listed bank, and if you're safeguarding crypto assets or digital assets, those assets must be accounted for as an asset, the corresponding liability, or as an liability, the corresponding asset on your balance sheet. And so when you take SAB 121, in combination with the capital requirements imposed upon banks by Basel III, you've basically made it really expensive for these tier one banks to safeguard crypto assets. As a simplified example, right? If a bank has $10 million of risk-weighted assets, they, or in general, they're required to keep an 8% ratio against those assets. And so, or total capital against those assets. And for certain kinds of assets, there's a multiplier for those assets. So let's say you have 10 million in crypto that you're safeguarding. The risk-weighted percentage for crypto is 1,250%. Okay, so you do the math. That means for every $10 million in digital assets, the risk-weighted number is 125 million, right? Well, 8% of 125 million means 10 million in total capital you got to keep, right? 10 million on the denominator, on the numerator, and 10 million, 125 on the numerator or denominator, sorry. 10 million on top, 125 on bottom to get you to 8%. So that means basically for $10 million in crypto assets you're safeguarding, you got to have $10 million in capital. That's really expensive for a bank. And so it makes it diseconomic for a large tier one publicly traded bank to safeguard digital assets. Now there appears to be light at the end of the tunnel potentially. We've heard reports that the SEC may be granting banks exceptions to this, so that allow them to safeguard digital assets. I think we're still waiting to get confirmation on which banks and if this is actually being put in practice, but there does seem to be pushback or exceptions being made to allow big banks to custody assets. So that's where I'll start. I think there are other considerations around obligations that banks have in terms of cybersecurity and AML and KYC obligations.
Right.
But the biggest thing holding the industry back when it comes to big banks is SAB 121.
So I'll just kind of follow up on a couple of things you said. So appreciate the requirements for like safeguarding crypto assets, but what if you're not safeguarding crypto assets? What if you're only facilitating money in, money out, right, for those crypto platforms? You're not sitting on crypto. Why is it so hard for banks to engage in those kind of business models, right? Like in Europe, we call it transaction banking. Elsewhere, you call it cash management. Why is it so difficult for tier one banks to provide vital cash management solutions that they have absolutely no hesitation to provide to the likes of Netflix, Airbnb, other digital first companies, but for whatever reason, Brian Armstrong from Coinbase waits for a bank account with JP Morgan for 2 years. Like, why is that the case?
My initial response is that it's risk. It's a risk reward calculation. How much do the banks expect to earn from facilitating these transactions versus both regulatory risk as well as headline risk that they take on, as well as sort of risk in the eyes of their regulators whom they need to keep happy that they're actively banking crypto. Now, when you bring in transaction banking, that just increases the risk profile, right? And right now you're seeing right now in the fintech and banking as a service industry, you're seeing regulators come down on banks who are actively facilitating crypto transactions or transactions in general on behalf of fintechs. And that's where sort of fintech banking and crypto banking intersect, because a lot of crypto companies seeking for transactional banking are essentially fintechs. And the model that was pioneered in the banking as a service space is now sort of being replicated in crypto. And the obligations of the banks that partner with these fintechs to monitor transactions is under scrutiny, and their ability to monitor these transactions based either on human effort or the technology they've employed is also under scrutiny. And you've recently seen enforcement actions at a couple of banks who are famously banking crypto. I won't call them out here just out of respect for these banks, but just in the last couple of weeks, you've had 2 enforcement actions from bank regulators on banks that are actively banking crypto. And those enforcement actions were related to the bank's ability to have KYC and AML policies. right? This is around the bank's ability to trace who is transacting on their books and records, and transacting through the bank. And so when you have the bank facing off against a fintech, in the bad old days, again, I'm going out on a limb here and generalizing, but in bad old days, you may not necessarily know who is transacting through the bank if the bank faces off the fintech and the fintech's records don't necessarily may not be comprehensive, and the fintech may not be passing info back to the bank. Like, who is it is actually transacting at the bank? That's huge risk for the bank. So then you bring in crypto, and there's a level of anonymity to crypto. And if you don't have the tooling to understand who is transacting, if one leg involves crypto, that again brings added risk to the bank. And so you're actually now seeing banks who are deploying technology and processes to address all this, and they are now actively banking crypto, and they're doing it in such a way that is likely to keep regulators happy because there's transparency across the entire process. But not all banks, and I'd say most banks, don't have the technology or aren't set up to do that quite right yet.
So Daniel, I mean, Frank showed us. I was quizzing Frank on okay, so custody and safeguarding crypto assets is one thing, and falling afoul of securities legislation is one thing, but transaction banking is another thing, right? Frank said that there are banks that are trying to up their game with transaction monitoring, with AML, transaction screening, trying to do this. Why are we not having that positive conversation? Why do we constantly headbutt? Where did this? What was the trigger point for this hostility? Was it really Sam Bankman-Fried?
Yeah.
Or was it an amalgamation of things?
Well, the whole thing blew up. FTX, Celsius, Voyager, on and on and on, BlockFi, the whole thing blew up. It was a bubble. By the way, this is it's still small industry, relatively speaking, compared to, where it's going to be. They had to learn some lessons. Okay, fine. We did have a self-inflicted wound. We did. But people took advantage of that. They overcorrected for it, as opposed to that conversation you're talking about. I've talked to a lot of bankers who would love to do it. And I will say, Frank touched on something really important, and this is actually perfect that the two of us are on this call. If you think about BitGo, which I always tell Frank, it's like they're the OGs in many ways. They're one of the OGs in the industry. Great company. But think about what BitGo does as a non-bank, right? As a non-bank, we'll call you a financial institution, Frank. I hope you're okay with that, because you are. The things that BitGo does, and I would say Orbital too, right? That we've built out this infrastructure that traditional finance institutions don't have. So if you say, okay, transaction monitoring, cash management, you didn't name them, but I'm going to. UTB, Evolve, which, by the way, is a dumpster fire that no one should ever work with. Sorry, I've worked with them before. But banks don't have they have good systems and maintenance when it comes to managing traditional compliance. But when you get into and say, okay, well, if you were to layer in some element of crypto, like an Anchorage Digital, which is the only approved crypto bank, there is, as you know, Adam, there is tracking and tracing source of funds using the blockchain, using a Chainalytics or a TRM Labs, or name your preferred analytics company. So you have to have that built in, that internal infrastructure around that tool, the people and knowledge about how to manage that, the nimbleness to manage around the complexities of regulatory, because crypto being cross-border, you're always going to potentially tripwire into some other regulatory environment, whether it be Canada or name your country, and then there's some complexity there. You have to be able to manage the technology part and all the cybersecurity part. We've seen DeFi being hacked many, many times. So whether you use a great infrastructure like BitGo, which I highly recommend for your digital wallet capabilities, right? Or whether you use something like a Fireblocks or whatever you go with, or you go with a traditional like a Coinbase where they're the custodian and you don't want to mess with that. Banks have to figure out, and any number of financial institutions, they have to figure out a tremendous amount of complexity around technology, regulatory, compliance, and all of that is a lot. Or you could just hire BitGo, or you could just hire Orbital to do those things for you. So I think what we'll see is eventually it's going to play out. It is inevitability that digital assets are going to be part of the conversation. It is 100% inevitable, because if the U.S. government says, let's just say they continue on this anti-digital asset, anti-crypto approach. Number one, good luck with this Supreme Court, because the federal courts are already knocking you out. And if anybody pays attention to U.S. law, the biggest SCOTUS action I've seen in this modern era under the Roberts, which there have been many things that have happened to the Roberts Court, especially lately, was when they overturned Chevron. And that Chevron ruling being overturned from the 80s is going to be so unbelievable for the crypto industry, because the SEC has already taken losses on losses. But that ruling was a message to all of the regulators, every single regulator. If you don't have absolute 100% clarity from the Congress as to when they wrote the law and when the president signed it, you can't just say, well, we're going to go ahead and take that and make that ours to regulate, because that's what the SEC did with digital assets. There's never been a law passed in the federal government in the United States. Yeah, we have state-by-state challenges that they have passed laws. There was no federal law. And the SEC just said, you know what? That's ours. And the CFTC said, you know what? That's ours. So we've got to get through that. It'll eventually happen. But I think when that happens, that day comes in the future, then the banks are going to have to use a BitGo and Orbital, or going to have to build out their own infrastructure in order to service customers, because it's going to happen no matter what.
Is that the way forward, Frank? That the banks will have to kind of dip into the emergent crypto industry and form partnerships and literally outsource some of that capability that we are, I think, all agreeing that they're lacking.
The train has left the station, so to speak. Crypto is a force that I don't think can and will be stopped by the incumbents, right? Due to the decentralized nature of crypto and the global nature of crypto, I think the banks at some point will come to the conclusion, if you can't beat them, join them. And to the bank's credit, all the tier one GSIB, too big to fail, even just mid-sized banks are looking at crypto in one way or the other. And when I say crypto as a general term, but they're already settling certain kinds of transactions over privatized blockchains. They're all looking at some sort of like tokenized deposit. Some of them are exploring and engaging with the public chains, not just privatized chains. And in some cases, you'll find one side of one bank that is really pro-privatized blockchain, and another side of that same bank is, well, we really want to do this on a public chain. And that's just in the US. And I think the non-US arms of these big banks, or the non-US banks themselves, are all doing interesting things. They all have proof of concepts. They all have innovation teams looking at it. We've talked to quite a few number of banks, both inside and outside the US, and there's a skunk works team at every single one of those banks. Some of these guys are really well read in on what is going on in crypto. Now, whether those banks actually action upon the insight that those teams are providing is a different story. At the end of the day, it has to make commercial sense for the banks. They have to make money on this. So I think they're all sorting out on how do they make money on it. Is it efficiency from what a blockchain can provide? Is it providing faster rails for payments? Is it reducing counterparty risk when it comes to security settlement or other kinds of settlement? Is it custody of digital assets? Is it trading in digital assets? Is it borrowing or lending against digital assets? Is it issuance of ETF? The banks are all thinking about this, right? Jamie Dimon may say he's not a big fan of Bitcoin, but he's very much involved. His bank, at least, is very much involved in the ETFs. So we're coming to a point where at some point the banks will either have to build, buy, or partner when it comes to custody. Whether that's going to be us or not, I can't speculate. And we are purpose built to custody crypto, to safeguard crypto in a regulated, insured, bankruptcy remote environment. And those three things I think are crucially important for anyone looking to custody digital assets. So yeah, I think at some point the banks will be forced to do this.
One of the things, and changing gears a little bit, but one of the things that make the banks or force the banks to do something is regulation, right? And it's been established, at least in Europe, that regulation, when implemented with enough consensus, can really, move the needle on banks' behavior or banks' treatment of certain business cases. A good example is PSD2, which even though didn't achieve everything that the regulator or the legislator intended to achieve, it created a much more competitive space in payments and with the overarching objective of protecting the consumer, or offering more options for the consumer. I think that objective has been achieved. Now we have MiCA in Europe coming up. It's actually already in force since June, and it's going to be fully in force in January next year. It raises additional questions, right? It is not a revolution. It is more of a step towards, towards clarifying some of the important questions about what is stablecoin, what is a crypto asset, what is a crypto asset provider, right? How does BitGo intend to navigate the kind of the changing regulatory landscape in Europe, and does that landscape have any bearing on what is happening in the US as well? Or is it almost like a secondary question?
I'll answer that second one first. And this is from a US-centric perspective. I think even if you have MiCA being effective in Europe, what we've heard from our counterparts on the other side of the pond is that even with MiCA, they're all still looking at what the US regulators are doing, right? So I think there's going to be a bit of cross-pollination back and forth, but I think you're going to see European regulators very much looking at the US and hopefully vice versa, right? That the US will take a page out of what's going on in Europe and provide some clarity. In terms of how is BitGo navigating this, we actually decided very early on to have a regulated presence in the EU by way of Germany. BitGo Europe is a German entity, is a BaFin regulated custodian now, and we set that up for the purpose of complying with MiCA and for the purpose of having a regulated entity where European clients can engage with digital assets in a safe and secure way. And so we have a team in Germany now. We're scaling that team. We're adding capabilities to it this moment. We hope to be one of the first out of the gate in providing digital asset services at scale under the new regime.
And does that mean you will or potentially are in process of applying for a CASP license out of Germany as well?
I think that's part of the process. Honestly, I'm not familiar if we're exactly where we are right now. And our ambitions, I will say, expand beyond just Germany. We also have licensing in Switzerland. We also have additional entities now being set up or already licensed and established in places like Dubai through Vara, Singapore through MAS, where there's a joint venture now between BitGo and Hana Bank in South Korea. We are looking to be regulated in as many jurisdictions as possible, without there being duplication, of course, but we're looking at where is there strong regulation, and where can BitGo set up shop so that we can enable a global sort of interaction with blockchain. And the ultimate vision here is, we have regulated entities here in the US, right? We're South Dakota Trust, we're a New York DFS regulated trust as well. When we can enable the interaction between customers of a regulated trust here in the US and customers of the regulated entity in Germany and allow them to interact with each other, that's sort of the grail of this is the goal, right? We want everybody to interact and onboard into blockchain and Web3 in a regulated way, and we're setting up entities to do that.
Yeah, I would assume, obviously you can't confirm, but I would assume that being in Germany, I mean, that gives you a really good platform to get a CASP license there, which you then can passport to the entire European Union, and it's actually the strongest license to be passporting, one of the strongest, if not the strongest. So yeah, I completely agree with the philosophy of enabling customers to do this in a regulated and compliant way all across the world. I'm impressed by that. Or how about Orbital, Daniel? How is Orbital following up on MiCA and other regulatory initiatives around the world?
Yeah, similar to BitGo, although BitGo being very, I view them as American-centric, right? Orbital is very British-centric. And so we've got regulatory licensing positioning in Europe, outside of Europe, in Gibraltar, UK. We're looking at Switzerland. We're doing something in Switzerland right now. So it's a similar dynamic. Companies should not be afraid to be regulated. But having engaged with a number of regulators, it is not a fun process. And Frank can speak to this. I'll give you an example. At a prior company that I was a founder for, which you know, Adam, we were going through the process with New York DFS. Now, Frank, they already have that. BitGo already has the bit license in New York, which is like, I think they only have now at the time. You have the bit license. You also have the trust, correct?
I think more accurate to say we are a NYDFS regulated trust.
Okay, as opposed to the bit license. Okay, as opposed to that. Okay, but either way, the trust is quite a bit. And so when I went through the process with the New York DFS folks, let me be clear. It's very important because I have a lot of animosity towards the regulatory positioning, but that's not the same as the people. The people in, like for example, the New York DFS, they're great. They're awesome, actually. Problem is, when they passed a law in New York in 2014, because they were forward-thinking, New York, like London, is a hub of finance in the world. They're one of the very few, top 5 in the world, right? So they pass a law. You got a banking center. They want to make sure it's regulated. Cool, great, no problem. You had a lot of companies go out there and get it. It's hard to get. But they didn't really give a lot of resources to the people who have to regulate. They just passed a law and they said, no, make it happen. And if you're not going to give enough resources, then what ends up happening is similar to, and I'll give you an analogy, we talk about the U.S. border, the complications we have in the U.S. border. One of the challenges is that, as an example, if you go to a port of entry and you claim asylum and you're just going to get your court date, that might take them years because they don't have enough judges to meet the demand for the number of people who are applying for asylum. So you get people staying in the United States, and that's a similar conversation. So you could go through this process for years. It was like that with the FCA. Now, granted, COVID really shook up a lot of people, but the FCA, which is a gold star regulator, had the same dynamic. New York, gold star regulator, same dynamic. And so you have this problem around regulations where you have a fast-moving industry. Great things. I mean, I can't think about how much has changed in the last 2 years. By the time you start to apply for these licensing and you get to the end, it's a different industry. So I would just say that the regulatory thing, I answered your question, I went beyond, but that's the problem I'd say is you're going to pass a law, make sure that these people who are being demonized sometimes, and they're wonderful people, they don't have the resources to do what the law has requiring them to do. And then as a founder or someone who's operating, Adam, you know very well, built Fiat Republic with your co-founders from nothing. It is so hard to do that. And so I would just implore governments around the world to come up with a strategy and make sure that the good actors out there, like the BitGos of the world, like the Orbitals of the world, like the Fiat Republics of the world, that are actively going directly to the regulators to get that to be good partners, it takes 2 to tango. So the company has to do its job, but also the regulator has to do this job, which means the legislatures who sign things into, or who pass things into law, they need to make sure that these regulators have the proper, financial positioning.
I would echo what you said. Actually, Fiat Republic being regulated as an electronic money institution, which isn't easy, especially in the UK and in the Netherlands, which I think is second only to Germany in terms of how stringent the financial services regulator is. And yes, I can also relate to something that you mentioned, that the regulators want you to give them a snapshot of what the future is going to look like with that license, right? And very often you give them that snapshot, then they expect you to execute towards that snapshot. The industry changes completely in the meantime, and then you're considered to have some challenges, right? All of a sudden, where did that come from, right? Some of the regulators are not prepared to keep up with the sort of dynamically changing industry such as crypto. and that remains to be the challenge. I just wanted to touch on one other topic which we kind of hinted on at the beginning of our talk, but TradFi and traditional financial institutions and banks run on data. Okay, TradFi trusts numbers. There's like ever since the inception of crypto, there was this like philosophical clash of crypto or pro-crypto movements really caring about anonymity, right, on the blockchain, and although there's this full transparency of all transactions on the blockchain, but they're all anonymous, right, and private, even though they're on a public blockchain, right?
Pseudo-anonymous.
Yeah, pseudo-anonymous, right? Whereas banks, as we know, and like back to the initial point about AML compliance, transaction monitoring, letting yourself be known by this sort of bank or traditional financial institution that is trying to facilitate the payment to you or from you, right? How does the spirit in which crypto is being developed fit into that sort of banking, traditional financial services outlook, right? From a data perspective, right? And I'll give you one specific example. How can we possibly combat fraud, right, in crypto, which has been one of the big points that opponents of crypto bring up all the time? Scams, fraudulent activity, right? How can we deal with that as an industry, right? When we have such a tension at the level of, can you share the data to tick off that box and complete an investigation, right? Or no, because all of my crypto should be private and the information related to me, my personally identifiable data, should be hidden, should be secret, and should be secured, right? How does that work in the long term?
If you don't mind, I'll take that because I have a hard stop in a minute. What we're seeing now is, I don't think we'll ever end up in a place where everything is anonymized. And I understand that a part of our ecosystem is very much into self-sovereignty and full control, and they want privacy. They don't want anybody having, a say of how their money moves and when it moves. I think the practical reality is, look, the banks are here to stay, and anti-money laundering regulations exist for very, very good reasons, right? You do not want to be accidentally funding a terrorist organization or some other bad actor. You're going to see technology come into play where you have self-hosted wallets that are going to be KYC'd and identified. One example of an initiative like this is MasterCard's crypto credential, right? And they've built this system to tag a real-world identity to or any number of wallet addresses, and they're working with ecosystem participants to do this. And part of that involves the verification of an individual and who they are, as well as the facilitation of passing along metadata or information to comply with travel rule obligations. So there are a number of these initiatives or technological solutions coming into play. Who will ultimately get adopted, I'm not sure. But I think the industry is actually very aware of this issue, and you have big players like MasterCard looking to solve this problem. So I'll leave you with that thought. I'll hand it over to Daniel, I think, who likely has even more insightful things to say about this. But I do have to go, and I do want to thank you for allowing me to participate today.
Thanks, Frank. Thanks so much.
All right, cheers.
Later, Frank. I hope that MasterCard thing dies a horrible, fiery death. And I think MasterCard is fantastic, but what I mean by that is there is no right to privacy in the United States relative to there's no constitutional protections for that. But people care about privacy. I remember when President Obama ran for president so in 2004, when Obama made a big splash and nationally, he spoke as the keynote speaker when John Kerry was the Democratic nominee for president to run against George Bush in 2004. And I remember the speech that was so famous. It was like the red versus blue states. It was such a passionate speech for somebody you'd never heard of before. And it was like, wow, who is this guy? Oh my God, he's amazing. But he talked about, he was trying to draw a parallel, whether you liked Obama or didn't. That speech was about, Democrats don't like, the government to come into our libraries and figure out who's reading our books, because that's what the old thing. The FBI would go into the library to see who checked out what book on whatever. Like we don't want that. And then they were trying to, Republicans don't want this, and was trying to say we're all the same, whether we have different, political points of view. There are things we all care about, and one of those things is privacy. People care about privacy when it comes to their guns. People care about privacy when it comes to what doctor they go to about their body. Like a woman going to her, doctor, and now they have these abortion laws where they're saying, well, let's regulate your menstruation period, your cycle. That's the same thing to me. How you manage your body, how you manage what guns which you own, which are, by the way, federally protected constitutionally. We have a lot of gun deaths, but that's a constitutional protection under the law. I view your ability to manage your private finances in the same light. And now we all got to pay taxes. We can't just send money to, a bunch of Russians to fund a war against Ukraine, which go Ukraine, Slava Ukraine, right? Like the point is though that we should at least think about things from the standpoint of privacy and respecting people's privacy. So that the beautiful part about it is that there's a peer-to-peer transaction where I'm sending money to a family. The government needs to stay out of my business. Leave me alone. There is a very deep-seated underlying feeling of that among Democrats, Republicans, and independents. People are like, leave me alone. And anybody who wants to try to mess with that, I warn you. Now, Coinbase, JP Morgan, name your institutional player, the Fiat Republics of the world, the regulated entities like Orbital, we all have to follow the law and do those things. And we should. We should be protections against bad actors. But that is separate from let's make sure to take a Chinese approach, and no disrespect to China or Chinese people, but the Chinese approach is top-down authoritarian. We want to know everything you do at all times. I fail to see much difference between the horrible communist China, authoritarian state and the United States government, or frankly, the European government when it comes to wanting to know what people do with their financial transactions. I can't differentiate. Can you, Adam? And you don't have to answer that because you're regulated, so you just go ahead and not say anything. You maybe avoid answering that question.
I mean, look, it is a balance, right? It needs to be a balance of what helps to tackle the issue that you have at hand, right? And the issue might well impact, like, you say respect people's privacy, but there's the respect of people's privacy to not make their details of the transactions or make their enhanced due diligence results known to anyone that doesn't have to have access to that. On the other hand, you have also facilitate a seamless transaction, right? And very often, given the ins and outs of the current financial system, those two objectives are at odds.
They are at
one
odds.
Another.
They are.
Right? And it's like, okay, so do you want a seamless, fast, frictionless transaction?
A cheap transaction for consumers.
And cheap, right? Or do you want full privacy, right? If you want full privacy, your transactions are going to be slow.
Yeah.
Because there's not enough data in the ecosystem to back up what you're saying. On the other hand, if you want a fast transaction, you need to be prepared to give away some of your right to privacy. You need to be prepared to inform and brief your financial institutions on what is it that you're actually trying to do, right? I always give this example is, imagine the bank currently, banking Coinbase, right? They receive a payment from Dan, right? Let's say via faster payments. Let's say we're in the UK.
Okay.
High trust, mature market. Dan sends money to Clearbank, right? In the UK, because Clearbank is the bank of Coinbase. So you're given a sort code and account number from Clearbank to send money to get a credit, to get your GBP to be able to trade on Coinbase, right? Clearbank has absolutely no clue who you are.
Coinbase does.
All they get is your first name, Daniel, and your last name, Goldman, through faster payments.
Correct.
And to Frank's earlier point, how on earth are they supposed to trust you on the basis of your first name and last name?
Well, what they're doing is they're doing business with Coinbase, and Coinbase is vetted out as the partner to validate
You
that
would
stuff.
hope, you would
Yeah.
hope, you would hope that it goes to the individual minutia of Daniel Goldman,
Yeah.
right? You would hope, but it doesn't, because that pipe is non-existent. It's only invoked when there's a suspicion of some illicit activity by Daniel, right? Or where there's a high risk that Daniel could be on a sanctions
Yeah.
list, or where the systems are, for lack of a better solution, based on some rigid set of rules, if this then that, are popping you up in the alerts queue of their compliance analysts for some reason, and then an investigation starts. Problem is, when you're in that flow, you're waiting for your money to appear on Coinbase
right.
for 2 weeks.
That's right. Well, but the problem that and you know this better, but like I would say you would be more knowledgeable of the pain points that exist in Europe and the UK just because of what you do every day. But the European and UK regulators, from what I can tell, have done a much better job. They're certainly not, they're neutral. They're not antagonistic to crypto in a way that the United States system is. So a lot of my comments are really, really targeted toward the current administrative system state we're dealing in right now. And I agree with you that the banks, the problem is if the regulator says this is the expectation of you, the bank, we expect you to do this, you're putting the bank in a no-win situation. And it's a dumpster fire here. Forget crypto for a second. The disaster with Synapse and banking as a service in the United States right now is such a hot topic. If you take crypto completely out of it, we have, because the Fed is supposed to be regulating all this stuff, and it has not gone well looking at the Synapse situation. So we do have some things to do. But to me, crypto solves this problem because the systemic risk issues around, like, let's just look at the Synapse issue. You're going to a regulate. Well, they are not. I don't remember what Synapse, what license that they had. I think they were operating as an agent with Evolve and other banks, but they're a technology service provider. But let's just say they had a license, or they didn't have a license. The bank, at the end of the day, is the licensed chartered entity, right? So people are moving their money through this entity, and then all of a sudden the money's missing. Whether that's FTX, Synapse, or whoever, that's a massive problem. And what I love about crypto is, for the first time, as you know, we still are going to need banks. They still have an important role in everything we do. But because of cryptocurrency, if not the I'm talking about the digital dollars, just what's the name they're coming up with for the Bitcoin, whatever. Bitcoin, right? GBP on the blockchain. So, the euro, they're making a big move on euros on the blockchain. For the first time, you no longer need another custodian to hold your money for you. Now, that's not for everybody, but for a lot of people, that's awesome, which means I can now, as an individual, do my own payments without the need to go to the bank to do the payment. But historically, we've always required a bank or a Chime or some company to do these services for us, whereas now, digitally, I can move money faster, cheaper, without any of the complexities, having to ask for permission, using the blockchain. So why would I use a bank to make the payment when I can just do it on the blockchain? You know what I mean? Like, eventually it's all going to go there, and banks have to figure out a way how to come up with a business model to navigate around that inevitable conclusion, it seems to me.
I've been saying for the better part of the last 3 years that if there were willing participants and players around the table, stablecoins could replace SWIFT like tomorrow. So and I'm seeing this, and we're seeing this certainly at Fiat Republic. More and more players are engaging in either issuing or consuming a stablecoin, or facilitating payments using a stablecoin, to a point where I think now with Micah and Micah legitimizes stablecoins, we're going to have stablecoin wars.
Well, I already see that happening right now. You see it right now. By the way, that is what, and not to, I'm going to pitch, but literally that's what Orbital does. Orbital is using stablecoins for money movement, right? Whereas you're banking crypto companies and not touching the underlying digital asset, Orbital is actually using those stablecoins for those cross-border movements in a regulated way. And I think that's going to become more and more and more relevant. If BlackRock is going to get behind it, you're telling me a $10 trillion asset manager, the world's largest assets under management in the world,
Yeah.
They're in this. You're telling me you don't think
Yeah.
that it's inevitable? You know what I mean? It seems obvious.
Yeah. Yeah. Cool. All right. Well, let's wrap it up. I'm just going to summarize just to kind of go through the points that we discussed with Frank and you, Daniel. So we talked about that banks are making changes to their AML and transaction monitoring systems, at least trying, some of the banks are trying to engage in what we call in Europe transaction banking, what people might call in America cash management solutions for crypto. And we're seeing some of that, although there's still very tentative attempts to participate in that space, but we're seeing some banks attempt at least, and try. We talked about there needs to be more collaboration between crypto infrastructure players like BitGo, like others, and banks. And that banks should potentially outsource some of the capabilities and know-how that they lack to players that have established themselves in this space.
Agreed.
We talked about data, how data can unlock transactions, or how provision of data can unlock transactions, but not at the cost of privacy. Although crypto platforms are acutely aware of the traditional financial systems requirements for more data, right, and transparency. They're also aware and want to respect people's privacy. And then we also agreed, I think, that protection from bad actors is very different from sacrificing people's right to privacy. So with that, I will wrap it up. Thank you so much for a really great conversation. And I would like to thank you and Frank for your insights and experience. It's been invaluable. I hope to the audience, I hope you've enjoyed today's episode. Please like and subscribe. As always, your support goes a long way in making sure that we continue to do those. So if you'd like to see more about what we offer and what we're all about here at Fiat Republic, check out our website, which is linked in the description. Thank you all for watching, and have a great time. And until next time, until we see you again. Thank you so much.
Thanks.